Hello and welcome to Options Guy TV. My name is Brian Overby. I'm known as the Options Guy. I'm also the author of the Options Playbook. Well, for just kicking off Options Guy TV, basically a week ago, we've had a lot of great shows in that we did it right at the beginning of earnings season. Usually, in my mind, earnings season starts with JP Morgan's announcement of their earnings, one of the biggest financials, and then usually followed by the rest of the financials. And then we get into the Magnificent Seven, used to be called the Fangs. They've thrown in NVIDIA into the mix, so they decided they needed to change the name. And we've had four already of the Magnificent Seven that have reported, but we have two behemoths that are going to be reporting this week. On Thursday, on the close, we have Apple reporting and we have Amazon. And I've talked a lot about pricing so far on Options Guy TV. And that's really what the show is about. When you think about the options playbook, we have over 40 different plays. I try to work as many of those strategies into specific situations where they make sense. I don't want to do a butterfly just because I'm a butterfly trader, right? I don't like to think of options that way. I want to take the strategy and I want to apply it to the conditions of the marketplace. And so this Thursday, we have Amazon and Apple that are going to be announcing earnings. And why it's so interesting to me is that we have fairly expensive stocks and we have a lot of volatility. They announce on a Thursday. That means that you have legitimately one full day of trading where all that volatility premium and time premium gets sucked away. And so the option strategy, so I always like to look at them as paper trades or always speculative trades. We've done a couple already on Options Guy TV. We're going to look at a couple of trades here in Amazon and Apple if we can get to it. We got a lot to try to cover today. On Monday's show, we looked at Charles Schwab, and I'm just going to recap that a little bit. We did more of an investment trade. We used an in-the-money call option as a way to invest in Charles Schwab right around an inflection point as far as the chart is concerned and be a little bit more long-term on that position. Got a couple of questions about possibly selling calls against our long call, which I'd like to even call it a surrogate for the stock. Very high delta. It was deeper in the money, a fairly expensive option contract. But if we look at the chart on Schwab, I'm going to start right there. I highlighted on Monday's show that we're really at an inflection point. This is a Fibonacci number, a 50% retracement from this high right here. And we're just sitting right there, the 200-day moving average. We got a gap that filled, and we're just waiting to see if we can break out to the upside. Part of the reason why we wanted to do a long call option as opposed to just buying the stock, right? So we're going all the way out to January of next year. And we're just going to let that sit. We're not going to sell a call on it. We're going to wait a little bit, see if we get a little bit of the breakout, and then we'll explore maybe selling some calls against our long option position. Enough about that. Other one that we looked at. So I'm going to have to switch up here 1 second. I'm going to switch up to my other charts here in Yahoo Financial because we're talking about oil today. So let's go back to the chart. And on oil, we mentioned a breakout possibility on Monday, and we did get a good run up, but unfortunately, it's not following through. But I do want to still look at it at a long call in the USO, which kind of tracks the oil futures. It's not exact, just like a lot of these ETFs that try to track commodities. But we're going to look at a long call in the USO, mainly because this is the week of long calls on Options Guy TV. So I'm going to stick with the theme. The stock came close to doing exactly what I wanted it to do on the chart. In that, let's look at what happened with oil. We mentioned this is a couple of year chart. Even though it says 1 year down here, we got a 1 day interval. We have a 200 day, we have a 20 day, and we have a 50 day. And it obviously the 200 day is a fairly big moment in the oil futures. And this is on the Mercantile Exchange. Here's the futures contract, the nearest term, the most active one right now. And we see we came up and touched it, We couldn't break through. We touched it again. We couldn't break through. We hung out there and boom, all of a sudden we had a breakout to the upside. And then we came all the way up to this high, got very close to it, and now we've sold off a little bit. So ideally, we're getting some follow through on the breakthrough on the 200-day moving average. Look at this. We almost have a golden cross here. I actually didn't even notice that until just now, where the 20-day is crossing over the 200 days. So that's a good sign. I like it. More important to me, I think, more significant if you have the 50-day crossing, but it's worth noting. And then if we run over to the USO, we see a very similar situation. And we even highlighted this area as a resistance on Monday's show. So when we were talking a couple of days back, we saw the USO have a solid breakout and once again touch the 200-day. This 200-day moving average, it was really hard for this underlying to stay above it and break above and stay, break above and fail, break above and fail 1, 2, 3 times. Finally break above, came back and retest, and now looking like it wants to break out, much the same as the oil future. And I can actually do a comparison here, and we can kind of see very similar movement. The USO doesn't do a bad job of tracking the oil futures. So now I added the green line, which is a comparison chart here, and you can kind of see the activity in both the futures contract. You see the run up here, and you see the oil going up. So just want to let you know that it is a little bit relevant. Here's a big dip that happened in the USO, and here we go down here, and we're seeing that move up right now. So interesting timing. We're getting into September and October. A lot of seasonality stuff that's happening. As a matter of fact, I saw actually on Yahoo Finance, and I kind of want to get my hands on this chart, but they looked at an aggregate chart of the VIX index. And let me switch screens again. Let's go back to where my TradeHawk software. And there we go. And we see that the VIX index right now has spiked. We've got a big down day in the marketplace so far, but markets can't continue to go straight up forever. But it is August 1st. Interesting. Well, what is the date? The day today is the 2nd, but we did hit August. And if you look at a chart over like the last, almost as long as the VIX has been calculated, now the VIX has changed their calculation, which is a little bit annoying, but there is a little bit of inconsistency in it. But over the last 20 years or so, we've seen in August, you start to see a gradual increase in volatility. And a lot of it has to do with what happens after August, leading into September and October. Those are some of the more volatile months in the marketplace. And the VIX chart and that historical chart actually showed that. So, if we are nervous about the marketplace and we have a lot of froth in the marketplace and we truly are still in the world of maybe a recession, we got a Fed a Fed meeting, and the Fed will speak afterwards. I don't know, Fed speak, that's an interesting terminology to use, but the Fed will talk about what their plans are after their meeting in September. So going into the seasonality of the marketplace is getting a little bit scary. And I guess that's the moral to my story. I put a lot of words in to just basically say that. And the VIX chart has shown that over time. Okay, so on the USO, we're going to speculate on it, mainly because we started this week. And on Monday, we did say our theme of the week is going to be long call spreads. Is long calls. The week before, we looked at long call spreads. So I'm going to speculate on the USO and oil going into the month of September. So I'm going to actually pick a longer term option, and I'm going to go a little bit out of the money. One of the things I do like about the USO is that it has really good markets, really tight markets. The USL is actually also an interesting ETF, and I kind of like it better in that they have different rules on when they're going to roll their option contracts. And the USL actually just stands for long term. It's not as much on the short term oil contract, but the option markets aren't as good. And it's that simple. So because I don't have as liquid of options and as tight of option contracts, we're going to hang in the USO. That's what we're going to trade. And once again, this is not meant to be a recommendation. We're just trying to learn. We looked at if we're buying call options and we want to do it on an underlying that I guess we're more investing in, and that's what I would say the Charles Schwab long call option was, then we're going to go deeper in the money. We're going to buy some delta. We're going to get some intrinsic value. We're going to get what we pay for. And our option contract was made up of a lot more real value and very little time value. Now we're going to buy all time value because we're going to speculate more on the oil trade. So we're going to go out to the September 15th date. Now that's 44 days away, and we're going to look at about a 30 delta in this underlying. So if I look at the 75 strike option contract going out, and we're showing here USO on September 15th. So we're going to have to keep the screenshot for a while. We're going to do the 75 strike option contract. And right now we see that that is trading at 146 on the ask, 131 on the bid. Now, that's not quite as tight as I was hoping that it would be. But so we're going to kind of work this order a little bit, and we're going to put it in. We got to, since we're doing only an individual option contract, we're going to have to give them a little bit more. On the long call spread edition last week, I should say theme, that was our moral to Options Guide TV last week. We did spreads. And with spreads, I have expectation of getting better fills because you're giving the market maker a buy and you're giving the market maker a sell. Here, we're just looking at buying an option contract. And so you're not giving them their hedge. You're not giving them an offset on the position. And because of that, it's a little harder to fill right on at the midpoint. So a liquid underlying like the USO, usually you can get a little bit better fills in, but not always. Okay, so I'm going to put it in. I'm going to click on the ask, and that's going to put the trade down below. We're going to look at doing, let's say, about 141. Now, one thing that is nice is this does trade in pennies, so we don't have to look at nickels. It's part of the penny project at the at the exchanges. I was going to say the SIBO, but all exchanges nowadays. And we're looking to buy this. So we're going out further in time, mainly because we are buying an out of the money option contract here. And I would rather err on having too much time, have to sell and still have something to sell, because let's say we don't get the breakout. If we go back to that chart, and I'm not going to go back to it, and we break down below that 200-day moving average, I definitely want to be out of the trade, right? Because we're trying to trade the breakout. We're trading seasonality of the marketplace, in the potential for oil to move to the upside. Okay, so here's going to be our official paper trade. We're going to buy one of the 75 strike calls that expire on September 15th, and that's how many days away? 44 days away. The implied volatility right now on that option contract is trading right around 29%. We'll call it 30. And that's going to be our paper trade for this Wednesday, Option Guide TV. Okay, so went through that fairly fast. If you have any questions, please put them in the comment section. We'll be happy to try to answer as many questions as you have and try to address them during the show. At the very end of the show, we'll try to get to them. Got two trades that I want to kind of toss out here. All right. Whew, I got to take a break. I'm rocking and rolling here. Here we go. Amazon is announcing earnings. So if I'm looking at Amazon, and I went out on Twitter before the show, I just put out a poll. My handle is @BrianOverby on X. I don't even know what to call it anymore. X, the bird went away, but I still think it's twitter.com. So very confusing, just like Elon Musk's son name that has a couple of numbers in it. So I guess it has something to do with that. But with that said, I put a poll out there, and please participate. It would be a lot of fun. Just follow me at BrianOverby and tell me, which stock do you think will perform better? And I'm not saying they're going up or going down, but which one do you think will perform better after earnings this Thursday, Amazon or Apple? And I'll give you some performance metrics because I found this very interesting this week. So I went out and looked at a year-to-date chart on Apple and on Amazon. And Apple just took over Amazon this week. It just happened this week. Apple year-to-date is up 54%, and Amazon is up 49%. Now, Amazon has came down a little bit from the beginning of the week, and Apple has stayed steady. So year-to-date, they're about the same. Apple outperforming, obviously. And then you look at the 1 year chart, and Amazon is actually down 2%, where Apple is up 20% on a 1 year basis. So find it interesting that year to date, Amazon's up 49%. 1 year, if you bought Amazon 1 year ago, you would be down 2% on your stock. Okay. So with that said, please go to Twitter and participate and play in my little reindeer game to decide which of the two behemoths that you, well, I guess I should call them the Magnificents, right? Because of the new name of the Magnificent Seven, is going to outperform after earnings. And they both might go down, but which one goes down less, I guess, right? All right. So on Amazon, one of the things that I would look at, and I would look at this trade on Thursday going into earnings, but we don't tape a show on Thursday, so we're going to look at it today. And the trade that I would consider, and I'm just going to look at both of them. I'm going to be very quick about it and just do a butterfly. I might consider a skip strike butterfly, but we're just going to have some fun. And one of the reasons why we're going to do this is that we have an Options Guy TV on Friday at 11 a.m. Eastern time. So the markets will be rocking and rolling on them, and we'll see if Amazon or Apple will be positive. If we had a lot of people out there watching, I'd actually ask right now, what direction do you think they're going to go? And you'd only get one choice. Either we're going to do put butterflies in Amazon and Apple, or we're going to do call butterflies in Amazon and Apple. And the market's down today. We'll do call butterflies. Let's just keep it simple. All right. So a little bit more of an advanced trade, and I know the theme's supposed to be long call spreads, but we're going to break the rule. So here we go. If I'm looking at it, I want to know what the expected move is over that time period. So now I have to go back and I have to look at Amazon, and we see that the stock is at 128. It's down $3 today. So it's down 2.5%. That obviously hurt the year to date percentages. And then we have the handy dandy thing inside the TradeHawk software that highlights where a 1 standard deviation move is. So if we look at the 1 standard deviation move, we know that that's right around 140. But if we look at the expected move, which is basically, we're just going to go ask to ask, it's going to be a little bit less. It's always a little bit less than the 1 standard deviation move. And we're doing it on Wednesday. Once again, these numbers would change on Thursday. So 465 is the ask on the call option on the 128 strike, and I'm highlighting that with my mouse, plus 435 equals $9. Okay, so the expected move is about $9, and you'll notice it's 137. It's a few dollars below the 140. Okay. We're going to go and center our strikes around the 140. We're going to hang and buy the 137. We probably go a little bit bigger. We want to give a little bit more of a slaw of a landing area, but we don't want to spend a lot on this. This is just a fun paper trade. We want to spend a few pennies on it on a 1x2x1 basis, which is a butterfly. Okay. So let me look at it. Let me start here. I'm going to buy. Here's the ask. Let's get rid of this trade, and we're going to buy, let's do 136. Okay. We're going to buy the 136. We're going to sell the 140, and then we're going to go 4 more points out and buy the 144. That gives us an 8-point landing area where this trade may be profitable. It's a 1x2x1. And as I promised, we're paying pennies, 31 cents. This trade would cost us $31 to do a 1x2x1 plus any commissions that you may pay. And that would be our maximum risk on Amazon. All right. And I'm doing okay here on the timing. We got another 10 minutes or so. Get your questions ready if you have them. So boom, let's go on over to Apple and let's see where we got. AAPL. This is just fun. The battle of the behemoth. All right. So 2 days remaining to expiration. We got implied volatility at 58. I didn't really look at it where it was in Amazon. I'm sure it was higher. The market is at 192.75. So if we look, this will be a little bit less of an expected move, probably a little bit lower volatility. 370 on the ask on that option contract to get the expected move. 330 on the ask on the put, and we're looking at $7. So $7 is going to put us just below 200, 192.50, and the expected move is probably 201 or so, somewhere a little bit in that area. So let's do the same type of thing with this scenario. Let me actually, I want to move this over here. Let's do that. Okay, so we got Amazon at 128 and we got Apple at 192. So a little bit more expensive stock. So option contracts would normally be a little bit more expensive. We're going to clear this trade out and let's do a battle of the bands here. A battle of the Megs. There you go. I like that. I made myself laugh. And it doesn't matter if you don't. I still enjoyed it. All right. We'll try to do 5 points. We did 4 points in Amazon, which is a little bit lower price stock. We'll do 5 points in Apple. Center it around the 200. And did I hit buy? Okay, so now I got to hit sell. And then we'll do 5 points and we'll hit buy. All right. 1 by 2 by 1. Unfortunately, that's going to be 90 cents. Okay, we got the right expiration. August 4th, 2 days away. Yeah. I was kind of hoping that would be a little closer to the 30-cent mark. But the vol isn't quite as high. And the higher the implied volatility, okay, so we're going to move it. We've got to go up to the 197.50. The higher the implied volatility, let me finish my thought, the cheaper the butterflies will be. You're selling 2 option contracts that are part of that position, and you need volatility to try to keep them cheap. And so what you want with a butterfly is you want vols to be high when you put them on, and you want them to come off and go down if you're correct on your forecast. You want that time premium of those 2 at-the-money option contracts to get sucked away. Hence the reason why I like to look at these trades around a Thursday earnings report when you just have 1 day to trade, because all that time premium, I don't care what the vol is, I don't care how much value is considered time premium and how much value is considered vol, because it's all got to go away on the close on Friday. So we're going to clear this and adjust it. Let's go here. Let's try to get it a little bit cheaper. Hopefully we can get another 25 cents or so off of it. 197. We don't have any choice we got to go 5 points because that's what the market's at. So 197. Sell the 202.50. And buy the 202 there, and then we go here. Now we're down to 70 cents. All right, so it's double. Well, we're still going to look at it. So we're looking at this trade. This will be our other paper trade, and we're going to do the battle of the Megs. We're going to do the battle between Apple and Amazon, and we're going to come back on Friday, and we're going to look at these 2 butterflies and see which one performed better. Please jump over to Twitter and just let me know what stock you like better, which stock you might think performed better after their earnings report on Thursday. And if I see we have a question right now. So let me go and pull up that question. Do you select your long call based on the delta? What would you consider to be an ideal delta for an out of the money call? That's a very good question. And I guess we kind of went through that. Now, if I'm buying an out of the money call, one of the first things that I want to look at is, do I think the stock can get to that range? In other words, if I'm buying an out of the money call, and I think we went back to the USO, I guess I'll pull up USO. We'll keep that there and we'll go back to the USO scenario. And in the USO, we were doing the September 44s, and we were looking at a 30 delta, if I remember right, which was 75, and we put this in at 140. Okay. So in this scenario here, and I'll clear it, I want to be sure that I think the underlying stock can get to 75. So to answer your question simply, the marketplace thinks that it can, right? If you look at the expected move where we're adding the ask to the ask, this is all the way out in September, and I think it carries a lot less weight compared to a shorter term option. But it still says that we're looking at $3, we'll call it about $5 or $6, and the 75 strike gets you there. On top of it, we're looking at the expected move, which is so nicely outlined in the Trade Hawk software, showing around 78, 79 is where that expected move is at. So a 30 delta, the marketplace is saying the potential, if you're correct on your forecast, for the stock to go to the strike and beyond is there. So so 30 delta makes me feel comfortable in that the marketplace, delta can be looked at as probability. The marketplace thinks that there is a decent probability that the underlying stock can get there. So I like to be somewhere within that range. And I want it to go beyond. If I only think it's going to go to 75, I'm going to buy the 73, right? I'm not going to just hope that it just gets to the money, because if it just gets to the money by that expiration date, guess what? I lost money. I needed to go through and get some real value, get some real intrinsic value for me to be profitable on that trade. So the delta right around 30 is an interesting number, and it's not a bad place to start when you're considering what you want to happen in your underlying stock. So thanks for that question. It was an excellent question. All right, so I see another question popped up. Can you go over 31 cents maximum risk calculation for the 1x2x1 setup? All right, that's a butterfly, 1x2x1, and that gets filled as a unit, which is very important. So as I kind of mentioned, when you're buying single leg option contracts, it's hard to fill closer to the midpoint. When you're doing, every time you add a leg to the strategy, that gives the market maker another hedge or something to work with. So the odds of filling closer to the midpoint on a 3-legged trade are even better than on a 2-legged trade, if that makes sense. 31 cents, yeah, that's my maximum risk, and that's kind of crazy. If we go back and we look at Amazon, I'm going to pull that one up. AMZN. Let's just look at how expensive, because I was talking fairly fast, running out of time a little bit, trying to get all these strategies in on a Wednesday show. But if we look at Amazon and we were doing the butterfly right around, I know wrong expiration. We did 1 point strikes. Okay. That's what was confusing me. I'm like, we did it 4 points wide. All right, so we're on the wrong expiration, August 4th. But if you look at what we were looking to do, 136, 140 here, that 140 is trading for $1.12, and we're paying 30 cents. If you looked at just buying the 136 outright, which is really driving our strategy, right? You're paying $2 for that trade. We're still going to get a lot of delta between 136 and 140 in our butterfly spread, and we're doing it and having a little amount of risk. Now the downside would be is that if Amazon gapped open more than a 1 standard deviation move and we didn't get the chance to actually trade out of it, that's probably the biggest risk. We get the benefit that on one day, all of this value has to go away, all this time premium that we're paying and all this juice. And now I can go back and see that the IV is 113. And this kind of explains, actually, this is a great lesson. It explains that why the Amazon butterfly is cheaper than the Apple butterfly. And it's basically the vol is doubled in Amazon. And that has a lot to do with why we can get it done for a cheaper price. That's simple. So with that said, this is a inexpensive way to take a shot on Amazon. Obviously, a very speculative trade because of just the 1 day of trading. And we'll go into less and less speculative trades once we get through the earnings season, but that's where we're at. All right. Do we have any other questions? No. And it looks like we're right at time. So perfect timing. So thank you so much for coming to Options Guy TV. Please click subscribe, ring the bell to make sure you get all the alerts, pound that thumbs up, go to Twitter and follow me at Brian Overby and participate in my little survey that I have about Amazon and Apple. Thanks for coming, and we'll see you this Friday, 11 a.m. for the next edition of Options Guy TV.